Hello, hello, guys. Welcome. Let's see if Fredy can join. Yes, he's here. Let's go, guys. Give me a 1 in chat. There is also Andrea for Fredy. Fredy today will go second part of the masterclass. There is this limit of Fredy with the microphone. Let's wait some minutes. How are you guys? I just received a message. I don't know if it's online. Vincent Khan, that he got blocked because he requested a $9,000 payout from Apex. So we are managing to get blocked from the major prop firm. Nice job. Let's see if Fredy.
Don't know what. Hello, can you hear me?
Yes, Fredy. Try to share screen.
Yes, sir. Let's
see if it works.
Okay,
guys, did you enjoy the last masterclass that Fredy did on how to use the option flow to frame? At the moment, I'm using this logic of the bias paired with the order flow every single day. And it's honestly amazing. Let's go. I think it's visible. Try to put full screen.
Can you guys see everything?
I think they can see. Let me wait. Let me check here. 1 in chat, guys, if you can see.
Oh, yeah.
Amazing. We can see. It's visible, Fredy. You can.
Yeah, I was moving away so I can't see the chat.
Okay,
sorry.
we can go.
Yeah, are you guys? Shall we go?
Yeah. It's visible. Everyone can see.
Amazing. All right, Fabio, thank you very much again for letting me be here. And it's my honor, honestly, to be in your community and bring this knowledge because I think everyone should know about gamma exposure. Regardless of the strategy or regardless of what they do, every trader should know about gamma exposure. And I am kind of 80-90% gamma trader, but also I do order flow and also learning from you a lot. So what we're gonna do today, guys, is we're gonna see and we're gonna learn how the big guys they see the markets. They don't see the markets in up and down. They see the markets in the relationship between volatility surface versus the spot. And there is a relationship that we're gonna study today. Guys, it's gonna be so simple to trade. I promise. The trades are so simple. You're gonna be amazed. But you need to understand the relationship between bull surface and spot. And I was telling, I'm gonna show you, but what we're going to do, once we understand this, we're going to trade NQ with these concepts. And as I said before, it's going to be so easy. So we're going to be focusing on a concept of max positive gamma, max negative gamma on NDX. Why? Because I want to get that explosion, that explosive move. I don't want the market, to be like going around. No. When we go to NDX on these levels, the market just go, okay? We're gonna see the XPX as well as a map, but since the last time I was telling Fabio, we constantly met with the guys from Guestbot and we constantly improve how the way we trade. So it's funny because before I met Fabio, we were working on how to be more precise in the scalping context, right? So today, what I'm gonna show you guys today is something that I've been trading in the last week, which is something new. I mean, new in the way that we focus on this. And I was telling Fabio, in 2 days, I passed 15 accounts from Apex. And it was only 4 trades, 1 stop loss. But the stop loss was my mistake, and I'm gonna show you. Okay,
Fredy, can I say just something, guys? It's an honor and it's amazing to see an ex-market maker coming to the retail world and attacking the prop firm. I love it, Fredy, and I hope we can make.
I'm scared now.
Some live. I hope we can make some live session trading Apex all together, because I
yeah.
hope they will pay you out.
I'm scared now that I hear that that guy from your community was blocked. My goodness.
But I told
now
them,
I'm not so happy.
brother, I told them, when this community will enter in the prop firm with this model, we will see a lot of block payout. And the first one is Vincent Kahn, $9,000 refused. But let's continue. It's okay.
Fantastic. So anyway, guys, so this is what we're going to do. We're going to see the market in a different perspective, no up and down, but we're going to see the relationship between ball, surface, and spot. And this is what the big guys do. Honestly, this is what they do. So listen, what we're going to do is I'm going to try, and with Fabio's, if Fabio allow me, I want to have another session because I don't think I'm going to have time to do everything. So
Of course.
today, what we're going to do, obviously, we're going to do the nature of the markets. We're going to go through something called guest spot research. We need, every trader should know about bowl events. And the last Friday, we have a bowl event. And before the market opened, I sent a message to Fabio and I say, Fabio, SPX 7,400 is a pin. You know, it pins means that the market will naturally, it's like a magnet. It will go toward that level. And we're going to see, I got that example today so I can show you. And then it went to the next gamma level, and then it went back to the pin. If you guys didn't know, on Friday we have OPEX, you wouldn't know that this would happen. So you should know the vol events, which I'm going to explain to you later. We're going to see, if Fabio allow me, we're going to meet again. But also with Fabio's authorization, if you guys want to learn more, I go on my YouTube channel, which is called Guest Future Trading. Now, if you type it in Google, it's the first one, which I'm very happy, you know, that Google actually put me in the first search engine. So when you type it, you're gonna see this one, and I go like 32 videos. If you guys want to, learn more, see more, and anyway, it's just there. Okay. Next time, I want to do Gets Order Flow, which is also, this is a spot on. That's why it's the most expensive subscription. And I promise you guys, I'm going to share with you the training I had, 8 weeks training with the guys from JP Morgan, Goldman Sachs, Citi, which is mindfulness for traders. Bear with me because what I'm doing, I got it in Spanish, so I have to translate it in English. So bear with me. I promise once I finish, I'm going to send it to you guys. But this is great, and this is very good because when Fabio invited me to this community, I saw, Fabio, that you are recommending some vitamins, like omega-3, lethanine.
Yeah. And also, guys, there is ashwagandha that now it's coming out, a lot of research about it. And also Andrea is using it, that is active in reducing the cortisol level. And we scalpers and traders have huge amount of cortisol. So please invest this $20 per month. It's really good.
Listen, I was taking some vitamins with the same components, but when I saw your PDF, I ordered all of them. I ordered the lethanine, I ordered ashwagandha, I ordered omega-3, I ordered creatine. So I'm actually taking them because they are very important. And when you do the mindfulness for traders, this mindfulness is scientific. It's nothing philosophical. Is a research done on thousands of traders, thousands of pilots, thousands of soldiers, and basically I like it, and it was so expensive, to be honest. I didn't pay, thanks God, but because this guy did this research with all these people, and they came out with this. So bear with me.
Fredy,
I'm gonna send it to you.
Can I ask you if we can, if you allow it, if we can share with the community the guidelines of the mental training of Goldman Sachs, Morgan Stanley, and that they have the big hedge fund? We can have a masterclass about it.
Amazing. Please, I want to be there.
Nice, thank you.
Yeah, amazing. All right, guys. So this is what we're trying to do next time. Not sure if it's going to be next Tuesday. I organize with Fabio. because I want to get this order flow just spot on as the same way as I had to the bold surface. Someone was asking me if how can I trade if I'm market maker for a bank? No, I am not a market maker for a bank anymore. So I quit my job 4 years ago and I came back to Colombia. I'm from Colombia. So I came back here, left my job in London. I came back here to be a retail trader because I saw someone was asking that. Anyway, so guys, listen, this is, I'm going to give you some heads ups of what we're going to do today. So I know the methodology that you guys are learning with Fabio and you know, but when you incorporate gamma in your trading, you can have this sort of trades. You can actually pick the bottom or tops of the market. And your job, Fabio, and the job with the community is kind of try to integrate this in your own trading, you know, in the way that you trade. I know that you got the IB model is to wait 30 minutes. But if you see here,
and look, Freddy, this is exactly what I wanted in the community, because when we have directional day, we make a huge amount of trades and high risk to reward. But when we have range bound trades, we can be chopped out. So exactly this, what you are providing to the community here, it's an amazing model for mean reverting from the tops and the bottoms that I think it's exactly what the community wanted to incorporate in the model. And the precision, guys, I'm testing it. The precision is crazy. Okay.
Yes. The precision has to do with the volatility surface and the way the market works. So if we will see it, but this is, just to give you an example, this is the trade I took on Friday. Okay. I took one long, and the thing is, we have a major open interest, which we will see later on. So I'm just going to give you some kind of preview. First of all, we need to understand bold surface. But based on the bold surface and what's happening here, we have a major open interest on NDX. And look what happens. Look the big trades, you know, in your language, you will see that these are sellers are trapped, right? So a lot of sellers here, they push the market down. They try to put it down, they couldn't, and then the market rally. But it rallies, it rallied there not because any other reason, but because of the bold surface and this major open interest, which we will see. As Fabio knows, I also working with my colleague Order Flow. We are obviously different approach of what Fabio does in terms of order flow, but it's interesting because when I started to work with her a year ago, she was telling me, and Fabio, please let me know because you are the expert, she didn't see anything to go long here. She was like seeing selling pressure. She didn't see any absorption. The speed of tape was pointing lower. The cumulative volume, the CVD, I think it's called, it was pointing down. So she told me, like, in the way she trades is nothing. The only thing that we can see is the big trades. Okay. So, but we have a major open interest. We will see this in real time, right? And I think when you combine this knowledge of gamma with kind of some sign of order flow, you will have these amazing trades. So I was telling Fabio, I passed 5 accounts with this trade. I have like 5 accounts copy with Apex. So I took one long here. I only with one contract. And then I used the 15 minutes volume profile, right? Just I know the 15 minutes is still a lot of hot tape, but when you trade with gamma, this is what you want to do. The first 30 to 45 minutes is when you have the most opportunities when you trade with gamma. And then you will have a lot of opportunities the first 2 hours, okay? But, and then when the price, so I took my first long here on the bottom, and when the price enter the value area low, I took my second trade long, okay? And then I went long until here, which is amazing because I have another open interest on the top in the value area high, okay? So basically, I have 5 accounts of 100,000 Apex, and on this move, I made $6,000 and I passed the account. I passed 5 accounts there. Now, the other example we're going to see is my stop loss, which is I want to bring it on because, look, I have a major open interest, which we will see. I just want to show you because this is so important for you guys. Look, I have a major open interest, which is the same as this one, which is a reversal. Okay, so the whole point of this open interest, major ones, is like they work as a reversal most of the time, like kind of mean reverting. But if you see the difference, I went short here and I quickly go my stop loss, $150 stop loss. Fabio knows, I was telling Fabio, this is the kind of stop loss that I have on Gamma. I don't risk more than 30 ticks, 50 ticks, because if it doesn't work, doesn't work. I have a Gamma level, and if that Gamma level doesn't contain the price and do a mean reverting trade, that's it. I'm getting out of it. I'm not waiting for anything to happen. So when you trade Gamma, it's very good because your stop losses are so small, like $150, compared with this potential $6,000 that I did. But what I want to bring on is look the conditions I have in here. I have big trades. I have sellers trapped. Look in my stop loss. I have nothing. You see, order flow was telling me, dude, there's nothing that shows that this is going to reverse, right?
It's the first time that I see you implementing all the concept, and it's amazing, Freddy.
Yes. So I want to bring my stop loss as well because, you know, for you guys, you need to find, and for you, Fabio, you know, order flow has to confirm the level. Order flow has to give you some sort of signal. You don't need 3, 4 signals. As long as you have one, is enough. Okay. So I have my stuff, $150. And then look, I had another, which I'm going to show you in real time. I had another open interest at 29,472. Okay. And look, what I have, big trades again, sellers pushing hard. And then when these sellers push the price hard, lower, that's when I take the short position, where until the next open interest, which is this one. So this trade, I went with 2 contracts in another 5 accounts of 100,000 Apex, and that's it. I passed. This trade was $6,000 with 2 contracts, and the risk was crazy. The risk was like $300 or $400. So, right, we're gonna see this with examples, but now let's go to the interesting part. Okay. Any questions, guys? I don't know, Fabio. Well, I have a little bit of water.
Go. I'm a student today. I'm listening to everything and I'm taking notes, guys. Something that Freddy is bringing here is something that I don't even know. Okay, so he's training me on the beauty of option flow, and I'm training him on the timing of the order flow. So yeah. Today I'm taking notes, guys. I listen to you, Freddy, and for example, it's the first time I see this calculator. I'm really curious to see how you use it.
Someone said that I'm gonna be put in a cage for terrorists. It's not terrorists. It's gonna make money. So listen, in order to take this kind of trades, right, we need to understand the relationship between the bull surface and a spot price. Okay, so what is happening? Let me put this one bigger so you guys can see it better. So what happens is when we work with Gamma, it's like we put lens into the volatility surface, right? And as I said before, the volatility surface is what the big guys are looking at all times. They don't care about direction. They care about volatility, right? So we are going to look this in different angles, okay? We understand that. That's the first point. We need to understand that the big guys look the market in volatility. As I promised, it's going to be, I mean, this is a lot of maths, but I'm going to try to make it easier. And it's simple to take the trade, honestly. It's so simple. All you have to do is just understand what happens in the level in terms of the volatility surface, which we're going to understand here. But that's it. That's it. And if the trade doesn't work, get out of it. 20, 30 ticks, get out of it. I did in Spanish to the community here in Latam. I trained like 400 traders on this, and they couldn't believe that my stop losses were so close. When you go to another kind of these gurus, Fabio academies, they say, oh, you have to put like 100 ticks stop loss, 200 ticks stop loss. With gamma, no. You just, 20, 30, 50 ticks is enough. If it doesn't work, doesn't work. Okay. And then we need a map also. Okay. We need a map of the market. It's not like I see the level and I go long. No. And this is the value that you bring here, Fabio, because you learn to people with the volume profile, for example, just to read what's happening. Where is the big concentration of volume, etc. So three things. You need to understand that this bold surface is what the big guys do and how they trade. Is going to be very simple to trade, but you need to understand the bold surface and you need some sort of map. Okay, you need to map, and this is what Fabio is telling you. Now let's go to the sexy part: how we trade NDX with GetSpot Classic. Okay, so this is GetSpot Classic, right? So you go into the GetSpot, you select Classic, you select NDX and Q, and more importantly, you need to select 90 days aggregate, because this is going to show me the interest, the position that we have in the market, where the big guys are positioned themselves. Okay, where are they positioning? So let me bring this one. Good. So first of all, we're going to use, as I say at the beginning of my presentation, we're going to use NDX, we're going to use XPX, and we're going to use QQQs. But we're going to have different trades with these ones, okay? Sometimes we align NDX with XPX as we align on Friday, which I'm going to show you as well. And that's a trade with lots of high probability, right? So listen, what we have to do, this is the operational setup. We use GuestBot with the 90 days, okay, the one that I just showed you. And then what we do, we try to identify the major nodes, okay? That's it. That's all we have to do. For instance, this was, let me go back, this was Friday, okay? So when the market starts to trade on Friday, you can clearly see which one are the major nodes, okay? So you can see it's this one and 2902, okay, on the way down. So look, where is the spot? The spot is at 9:36 a.m. is at 2:31, okay? So you have this node, you see the green one? You have this one on the top, but those ones are not the major ones. Which ones are the major ones? This one on the bottom, the 2902, and this one on the top, and this one's on the top, okay? You don't have to do nothing. All you have to do is you have to wait for the price to go to either of these two levels. That's it. Why? Because there are big guys positioning here. Okay? They're there. And when the price goes there, it's going to find reaction. The first thing that we look for is for mean reverting trades. What I mean for mean reverting trades, that if the price goes down, right? Look where the price is. If the price goes down, my first reaction is I'm going to look for a reversal on the way up. And this has to do with the volatility surface, okay? I'm going to show you the trades, then we're going to go into the volatility surface. Now, what's interesting is this level. Oh, wait a second. Wait, too much. I'm going to put it there. So the market, look, when the price was here, the market went down to that big level, look, 2902, and reverse, okay? Let's go to put it just there before it reverse, okay? So this is what I'm looking for. I'm looking for a reversion only on the big open interest levels. And forgot to mention, when you go into Classic, what you have to do, you have to go here into open interest, turn off volume, and turn on open interest. Okay? Why? Because that's going to show you only the big interest where the big guys are. Okay? Does that make sense, are you?
Reply in the chat to Freddy, guys, if it's all clear. One, it makes sense, Freddy.
Okay, good. I'm looking also the chat. So the point is, again, if we go back to the step one, we need to identify the major nodes, okay? This is a big concentration of interest. This is where the big guys are positioning. Now, if you see here, this is 130 million of gamma based on contracts, on open contracts. So it's a lot of money, okay? Now, I'm gonna mix a little bit, but this just on Friday we have OPEX, which was OPEX is the spread, the monthly spread of these options. It's an important day because usually the big levels on XPX they get pinned. So as I remember Fabio, I say Fabio, today the 7,400 is the pin. So when the market go there, and then let me show you here. Oh, and this is getting into guessboard research. You guys see my screen now, yeah?
Yeah, it's visible, Freddy. It's the GEX open interest in orange and red, right?
Yeah, exactly.
Okay.
So look, this is guessboard research basically show you the positions of the market before the market opens. Okay, so you can see that the market opens around 7,413 or 20, which is around here, okay, around this level. But look, where is the big level? Is the 7,400 here, this one. It's a big concentration of puts and a big concentration of calls. And that's what I test you before the market order. Fabio, there is a pin in 7,400.
I remember, and Friday was a garbage session because the market stayed around this level for the whole session. So it's filtering choppy days in an amazing way. And 1 second, Freddy. Nicolas and Xax, you have data to do some quantitative research on options on the research part, okay? Because on this one we can study and see if the losing days is exactly where we have a large pin. Yes, deep charts is working, guys. I'm with the platform open, everything working. They had the problem with the X feed in the opening, but works fine.
Exactly. Good. So look, working with gamma and knowing these volatility events are important. Okay. So actually, Friday was a good day for me because I passed 5 accounts with the trades that I showed you, knowing that the market, if the market goes to this level, 7,400, my first reaction is what? Is going to bounce. Okay. Why? Because this big interest and the volatility surfer relationship with the spot usually made this bounce. Okay. And then bounce to where? To 7,450, which is the next big gamma. Okay. That you have it in your mind. And if I show you, this is guessboard research. I'm gonna teach you guys how to use it. But basically, this screen before the market opens is showing me all the calls and all the puts, so I can identify the big levels. But also, we can see like kind of the net value. Okay, so basically what they do, they say, okay, calls, puts, we're gonna net them out, and then look how beautiful it looks. Now we have two big levels, the 7,400 and the 7,450. When the market opens, these ones in the middle disappear. They liquidate this one, and we only ended up with 7,450 and 7,400. So this is important because if you see the table on my right, this is the options for the next 98 days. And as you guys, I do 100% believe that this positioning of these guys is what moves the market. Okay. So I'm interested to see how are they positioning. Okay. So what I saw is like, fine. If the market goes down to 7,400, I'm going to buy. Okay, in gamma terms without any order flow. And then if it goes back to 7,420, I'm going to find friction. Okay. If it managed to go higher, it will go to 7,450 and that's it. It won't go any higher. You see there is no gamma above this level. What it means, if I don't have gamma, the price is not going to go up. I mean, I'm going to say this with 95% confidence. If you don't have gamma, price is not going up. If you don't have gamma below, price is not going to go down. Why? Because there is nothing that tells the market maker you need to keep selling futures. If you guys remember the previous lecture, the market maker, when he need to delta hedge using gamma, he will need to sell futures on the way down until this point. Why? Because below there is no gamma. So he doesn't have any need to keep selling options. On the way up, he doesn't have any gamma above, call gamma, to keep buying. So basically, later on, I think an hour into the trading session, I test Fabio and say, Fabio, we are going to be between 7,400 and 7,450. That's it. This is the game. We're going to be between these two levels. And thus, when I took the long here, and then I took the short on the way up. Okay? Knowing this, knowing the positioning of the next 98 days for these guys. So if you guys remember that graph, so basically this is the 7,400 in XPX where I took the long. And this on the top is the 7,450 where I took the short. Now, what's interesting for me from a kind of academic point of view is the same guys on NDX basically were, I mean, these guys in NDX, they were positioning in the same level as XPX. Does that make sense? So the big guys with big pockets on the Nasdaq, they probably saw what we are seeing, the 7,400 XPX, and they positioned themselves. And then on the way up, they also saw that there were no more gamma above, so they positioned themselves here in the 7,450 XPX. They positioned themselves in the 29,472 NQ. And I found it amazing because, you know, I like to trade, but also I like to put hypotheses on the market. And my hypothesis is everyone is looking the XPX. That's what I put it here like this. Everyone is looking the XPX. The guys who trade Qs, the guys who trade NDX, they are looking the XPX. They are looking at these important levels, and that's where they position themselves when they look these important levels. And that's how we can take advantage of that. All right. Now, this is step number one. We basically look for big levels. We don't need to trade in between from a gamma perspective. Why? Because when you trade between big levels is when you get chopped out, right? Is when the market, you get lots of stop losses because you think it's going to go up, then down, then you get your stop losses. It's better to wait for these big levels and take positions there, okay? So now step number two, wait for the price to get as close as possible to the level before seeking a mean reversion entry, okay? And this is a concept which is difficult to incorporate sometimes because when you do your analysis and your Monte Carlo simulations and you do, you know, your back forward simulation, you want to get into the trend, okay? And I always remember Fabio, when Fabio say at the beginning when we met the first time and I was showing him my mean reverting trades, he said something which is right. He said like taking a mean reverting trade is like trying to stop a train which is coming at 100K per hour. And you're right, okay? You're right. But the thing is, if you want to stop the train here, you're gonna get chopped out. You're gonna get your stop loss. If you want to stop the train here, you're gonna get a stop loss. So people who doesn't see gamma, they will try to, because you know, markets tend to go up most of the time. That's the nature of the market. And the Nasdaq sometimes, or most of the times, it goes a B reversal, right? A B-shaped reversal. So people try to take that low of the market, but listen, if they don't have gamma, they're gonna get so many stop losses, right? It's better to wait for the big level that you know that big guys are there. Okay, we're gonna see why this reverse. Okay, but step number one, identify the major nodes. Step number two, wait for the price to get as close as possible. I like it when the price on the way down. I like it when it crosses like this one. You see, it crosses a little B and then reverse. You see, it crosses the level and then reverse. One thing I have to say about if you're, you guys are using deep charts, but if you're using ATAS, you can put these levels in your ATAS platform, which is much better because this price is actually calculated with the guys from Guessbot. So basically, what happens? They send the premium in the morning. What is going to be the premium for the day, and they calculate the price. Okay, that sometimes is not accurate by few ticks. Okay, so just bear that in mind. This price is not accurate by a few ticks, because if I show you what actually happens on 29102, you see that the price didn't touch it here in Guessbot platform. But when you go to the actual uh, NQ, you see where the level is. Actually, the price cross it and reverse. And this is the trades I like to take, because I know I have a stop loss in place now. You know, I can put my stop loss on the low or below the big trades or whatever, but I have something to put my stop loss. I don't have like a subjective stop loss like 100 ticks, 150 ticks. No, I have a stop loss by structure. Okay, is it clear until there, guys? All good? Amazing. Now, this step number 3 is where you guys need to apply all your order flow knowledge. Okay, why? Because you need to analyze order flow around this level, and the closer the price get to the level, the tighter is your risk on the trade. Okay, so please, 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 if you see that the price is going like here and you see the big level, don't buy until the price gets very close to the level. Okay, and someone say, how do you correlate the XPX to NDX? I'm gonna show you in a minute. But anyway, Guessbot already calculates your NQ prices based on NDX, so you don't have to worry about it. Okay, now step number 3 is the job that you guys need to do. And for me, for instance, was learning order flow and learning any sort of signal that order flow is telling me this is going to be a reversal. For experience, I tell you, it's not going to be 3 signals together. You're not going to get the big trace. You're not going to get the absorption. You're not going to get the tape, the speed of tape. You're not going to get the cumulative value. Why? Because order flow is showing you that we are going on a way down. When can you see the actual order flow signals? When the prices start to go up. So now you start to see, oh, I go like positive deltas. Now I have the speed of tape is showing positive, and now the cumulative value is going higher. How can you use this? Well, if you miss this trade because you don't want mean reverting trades, you can do what I did. You know, just use the volume profile and think that if this reverse and enter in all this area, probably is going to find the next level. Okay, but the whole point of you guys incorporated gamma is to have a look at these trades. And as I said before, one signal is enough. Big trades, absorption, rejection. What other, Fabio? Help me here that you're the expert in order flow. Any signal? I don't know.
Yeah, you can have absorption, you can have exhaustion of the market, you can have aggression with big trades, initiative auction, any volume confirmation, but framed at the level that you are saying.
Yeah. And for me, you know, this big trade, in order flow, when I learned, when my colleague told me this, She said, "Oh, the sellers are trapped," and I was like, "No, the market maker is here. Here is the market maker. We know the last lecture what the market maker does. So basically, the market maker was here. Okay, and that's my view of the market. I see the market in terms of gamma, so that's what I see. So anyway, this step, this is the steps that you guys have to do. Okay, and it's also important, and this is what you learn with Fabio. You need to have a sense of flow. You need to see what's happening in the market. For me, if you remember, guys, the market rally on Thursday. This trade was on Friday. This was a Friday trade. This was Friday. But if you guys remember, on Thursday the price rally, and then overnight it just collapsed. If you guys remember, the market just collapsed on Friday overnight before the market opens. So, and I knew that 7,400, and for me was easier to look for longs. Okay, but that's something that I developed. It's more like some market analysis rather than going deep into the context. So what I try to use that what is called market regime, right? So are we in a high or low volatility regime? If we are in a high volatility, which I measure with the VIX, I kind of tend to think that these levels are going to be crossed very heavily because the volatility is high. So they're not going to contain the price as we saw it here. They're probably gonna cross the price with big force and then come back. Okay, so that's what I say. I like to take these trades when the price come down and reverse, because then I can put a stop loss, right? And then if for any reason there is high volatility and the price keeps going lower, I'm not in the trade until the price reverse or until it goes to the next important node. Okay. And this is the intraday context where you guys are learning with Fabio. For me, in Gamma, the first 30 minutes is when I have these opportunities. Okay, mean reverting opportunities. Because if you guys study the first 30 minutes on any, in the market, look, this yellow box is the first 30 minutes. So the first 30 minutes is when you have these moves on, this kind of mean reverting moves. Then after the 30 minutes, I do agree, you have your kind of trend following, right? After the 30 minutes, you have the trend. But the whole point is you guys are learning something new. And with Gamma, you shouldn't be scared of taking these trades within the 30 minutes time frame. Even with the first 15 minutes time frame. That's what I have, the 15 minutes as well. Okay, because it gives me a little bit of information. And because I trade Gamma, I know the first 30 minutes is when I have these mean reverting trades, and then I have the trend. Okay, how do you check volatility again? With the VIX. I'm gonna put it here. You need to have a look at the VIX. I'm gonna put it in the chat. So normal volatility is around 20 to 24, and high volatility is, I gotta put in the chart, is greater than 25. Okay. Also, low volatility is when the VIX is below 15. I'm putting everything on the chat. Let me see. So why this? Sorry, as I said before, it's a lot of things, but if you guys want to learn more, you can go into my channel. But when you have low volatility, what happened? When you have volatility below 15, 14 in the VIX, it's going to be so slow. It's going to be choppy day. The market won't go anywhere. And that's where you can establish mean revert, you can establish this range bound strategy. That's how you call it, Fabio, like range bound strategy, or how do you call it? Maybe.
Yeah,
When
mean revert.
Yeah. But your shop channel, I don't have shop channel. Anyway, so guys, Fabio, are you gonna share this with the community so they can have it?
Of course.
Yeah. So anyway, you guys are gonna have this. I prepare it for you especially, so you guys can have it. Now, um, well, this is what I was saying. The market sold off sharply overnight on Thursday or Friday morning, but the bias was upside. That was my context. So I was looking. The STS, the XPX tested the 7,400, which was the pin, and rally from there. Okay. Now, why do we use the open interest? And this is new, Fabio, because remember when we met, we were looking at gamma levels. Now we're looking at open interest. This is the big change that I was telling you before. Why? Because gamma, as the price move higher, gamma increase. Okay. So gamma increase. Let me. Oh, I thought I have this ready. Sorry. Okay. Look, as gamma got higher, as the price, oh, horrible. As the prices start to trade higher, what's going to happen is gamma is going to increase. Gamma is going to increase. But gamma in classic basically say if someone buy a call, oh, I learned this sometime. If someone buy a call, right, the gamma is going to increase. Okay. But if someone sell that call, this is selling of a call, that gamma is also going to increase. Why? Because GuestBot is measuring, for instance, let me put in gamma terms. Sorry. Let me put SPS. Let's put it today, for instance. Here we go. And let me put gamma and take out open interest. Here we go. So you see this gamma, positive gamma on the top. Let's put it on the example on the way up. When someone buy a call, this, well, let's say we're going down. When someone buy a put, the gamma is going to increase, right? At the moment, it's 45,000. When someone sell that put, this gamma is also going to increase, okay? Because this is measuring the gamma based on price movement, okay? Now, if you recall what we are looking at, we are looking at places where the bid guys are positioned, okay? And not only today, but the day before or 3 days before. So now what we're looking, and this is what changed, Fabio, is we are chasing these big guys. And they tend to high in gamma, but when we put open interest, is the amount of contracts. Guess what? Basically does the calculation, and they show me the amount of contracts. All right. So I can clearly see where the big guys are positioning. You see, I basically clean the noise. Okay. I clean the noise and I go only to trade on these big nodes. I was talking to Jazz, which is the creator of GuestBot, with John, but John trades options, Jazz trade futures. And I was telling Jazz, what about these middle nodes, the small ones? And he said, I don't care about those. I just care about the big fish. I care about this big guy. And also, I care about these big two guys. I don't care about these small ones. And that makes sense. Like I tested on Friday because in the past I was trading the small ones and I get chopped out. Why? Because the market could rally, rally, come back, and I go like 1, 2, 3 stop losses, which I didn't care before. But that mentally drains your brain, mentally drains your, you get tired of having like 2 or 3 stop losses. Now, if you go where the big guys are, boom, this is going to reverse very heavy. And on the way up, boom, it's going to reverse as well. Okay. So basically, if you guys see this, the big guys are here, 29,102, where the price reverse. And the big guys are here, 29,377 and 29,402, with respect to the price. Okay. Because the price is here in the middle. So I can see the big guys are these two and this one as well. Does that make sense? Someone is asking, Andy, how big does it need to be? Listen, This is what we like. This, it doesn't, you don't have to have a number. You have a reference, a visual reference. The price is here. This one is small in comparison with this one, right? This one is small in comparison with this one and these two. And this one is small compared to this one. So which one are the big guys? This one here on the top and this one here on the bottom. Does it make sense? Okay. No, I also consider negative gamma, right? I also consider these big guys, and I'm gonna show you why. And remember, this is open interest. So what we need to do, remember, identify the major nodes. I'm not saying the green ones or red ones, just the major ones. That's a concentration of interest. Okay. Oh, sorry. And that's it. That's the easy trade, right? That we just put it there. And important to know is this open interest is of the pre-market. Okay. So if you go to Guestbot and, for instance, you see it today, well, NDX today open interest. Yeah. So basically, let me get open interest. Okay. Look. These levels here are updated pre-market. So the exchange send the information around 1 hour before the market opens. So if you have Guestbot and you want to see the levels that you're going to trade today, okay, you have to do it around 1 hour before the market opens. Okay. That's it. And this is a lot of things that you guys can read, but now comes to the sexy part for me, at least. Why? Where I put it? Okay. Why? What's the relationship between? Let me put it here. I got it here. Here. Okay. Now you guys say, okay, fair enough. I know I have to put. I know I only need to look for those big levels. All right. I know I only have to trade on these big levels, but why? Why those levels work? First of all, is because the big guys are positioning. Okay. Now, there is a relationship between this is the volatility surface and the spot. Okay. So when someone buy options, they take out liquidity. Okay. So basically, it's this big part here. So when they take out liquidity, sorry, I forgot to explain this a little bit better. So this is the volatility surface, okay? And that's what I say. When you look into options, you don't look up and down. You look into the strikes, which are kind of the price of the options where you can trade. You look into the spirit, and for us is 0 DTIFs. So this will be 9:30 in the morning. This will be like 4 p.m. And then we have to look into implied volatility, right? So what's happening is this is what the big guys are looking. As I say at the beginning, they are not looking at up or down. They're looking onto this volatility surface. Why? If you remember the example on this one, when the market went down, sorry, let me put it again. I just need, right. So the market went to this big level, 29,102, and rally, okay? If we see it in terms of the implied volatility, what we see that, let me put this right. Oh, I need to put this better. Hang on. Yeah. Ooh, yeah. So what happened what happened with that people or that institution or that group of institutions that put that big open interest there? Basically, what happens is implied volatility increase. You see? Let's imagine the market is here, and when they put that big open interest, immediately the implied volatility increase. Okay? And when the price, if you imagine a ball, what happens when the ball goes to the top? physics, the ball went down, right? It's no more way to go. You see, does that make sense? So they buy, let's say the market was here where I got this, my cursor. They buy that call, or they have this big open interest that's magnet for the price. Why? Because implied volatility increase. And once the price get there, what's happening is just tend to reverse. That's why we do mean reverting trades. It's the nature of the market. Is what was these guys know that the big guys are trading this volatility surface. Okay, that's the hard explanation, but I go an even better explanation for you guys. And this I did this with Clouded, and I said, Clouded, help me to explain this in a better way. And I said, listen, you go a big pin gamma, which is the big level. What happens on the way up is friction. Why is friction? Because remember, guys, remember that what we saw the last lecture or the last class is if we have a big level on the top, let's say, oh, that's horrible. If we have this level on the top, right, and the price is going higher, it doesn't be top or lower, it doesn't matter. If price is trying to go up, remember that in when we have a positive environment, you remember the volatility trigger or the flip side. When we're in a positive gamma environment, what's going to happen? We have a market maker buying on the way down. When the market goes down, he buys. And when the market goes up, he sells. Right? This is the nature of volatility suppression. That's what it calls. And why the market maker is doing this? Because remember, yes, he has zero DT options to hedge, but also he has a non-zero DT options. Okay? And remember, what's his job? His job is provide liquidity, but he needs to do delta zero all the time. So in order to be delta zero all the time, what he needs to do? He needs to buy when the price goes down and sell when the price goes up. And I truly believe that the moves that we see in the market, you know, when we have these higher high, higher lows, higher highs, these moves are because of the market maker is doing this, you know, buying, selling, buying, selling. I truly believe it's the market maker. So anyway, back to our example. Look, when the price is going to a this pin magnet is going with, imagine this mountain is muddy, right? And you have a ball. So when you try to push a ball through a muddy, to a muddy mountain, you're going to have a lot of friction, You're going to have this friction. When we get to the level, usually, and that's what we see in order flow, we have some sort of, we get to the pin, we get some gamma, so it's going to be a little bit of friction, okay? And then what happens is an acceleration of the price, okay? Why the price accelerates? Because there is this market maker is no longer putting a brakes on the price, right? And it has to do with delta. And let me explain that. Hang on. So this is the delta profile. Just be with me, guys, 1 second. I need to, at the moment, if you guys got a question, but let me, this is very important for you guys to understand why. So this is the delta from a call, which goes from 0 to 1. 0 to 1. Okay. So this is the delta of a call. Let's put it this way. This is call delta. Okay, and then we have a put delta. Let's put it in red. And then we have the put delta, which is like that. And the put delta goes to -1. Oh, sorry, I wish. It goes to -1 to 0. Okay. Now, what? I'm sorry, I'm gonna get a little bit. I'm gonna get deep into maths just a little bit. I promise it's just a little bit. So anyway, this is the delta. Oh, need to put, and this is put delta. All right. So call delta goes from 0 to 1. Put delta goes to -0 to 1. This delta, remember, is what is telling the market maker you need to be delta 0 in order to be delta hedge, right? So a little bit of maths is telling me, how do I calculate the slope? So the delta, the gamma is the slope of this, right? So basically, if I do a little bit of maths, oh, not that color, this one. I need to do a little bit of maths and say, okay, so I'm going to use derivatives, and that's what I call first, second, and third order derivatives. So I need to measure x1 to x2, and I need to measure on the way up. So if I measure this, I'm going to be able to measure the slope of this curve, which is my delta curve, okay? In mathematical terms, it means that gamma basically is the change of delta with regards to the change of price. Okay? This is important to know. Why? Because when this gamma is positive, right, the market maker is buying more. So when the price is going up, let me put this one. All right. So remember, when the price, let's imagine in this, we got the price, right? So when the price is going up, is going to the right, what's happening? This delta, this second order derivative is telling the market maker, you need to buy more, okay? But look what happens, and this is the example of this gravity ball, right? This is market maker buying on the way up, okay? But remember, he also have a portfolio. And to be delta neutral, this is widely studied, it's a lot of research. And basically on the way up, he needs to sell. On the way down, he needs to buy because he's in a positive gamma territory. But when we analyze in general with that option, he needs to keep buying. Why? Look, as the price goes to the right, his delta is getting to 1. So basically, as his call delta is getting to 1, is basically telling him, you need to buy more, you need to buy more. Now, what happened with the put? With the put, it's exactly the same. You know, we need to measure from x1 to x2, sorry, and on the way up. Okay? And that we're going to measure the slope. This is our derivative. So again, so gamma is going to tell, okay, we're going to measure the change. Oh, that's not nice. We're going to measure the change of delta with regards to the change of the spot price. But look what happened with the call, with the puts. We are, as the price got higher, we are going to 0. What does it mean? It means that when the price is going like this, every time the market maker needs to buy more, you see? Because his delta, oh, not that one. His delta is closer to 1. So basically he needs to buy more. And this is called delta. And his put delta, let's put in here. His put delta is telling him, you know what? You are going to 0. So you need to sell less. Does that make sense? Sorry, guys. But you need to understand this. Otherwise, you know what? because I trained these 400 traders. If they don't understand this, they see the level and they're not gonna do it, right?
Fredy, I'm speechless. Like I'm watching now, and I see the community. There will be some people that will not understand everything in this.
Yeah.
But guys, this is how the market moves. This is how the fucking market moves. We are watching the result of the interaction of the orders. Fred is giving you the reason why orders move.
Yeah. So this is this. Obviously, you guys review this, but basically, what is this telling me? It's telling me exactly this. This that I put here. You know, there is friction on the way up. Why? But because market maker is buying on tops, buying on bottoms, selling on tops, but every time he gets close to, every time he gets close to this pin level, right, it's going to happen this. He needs to buy more because call delta is getting to 1. He needs to sell less because delta, so put delta, this put delta, these guys on the bottom, he needs to sell less, okay? Now, what's happening on the top? What happened when we get to that level? There is friction. We get to the max gamma, right? That's usually when they say frenetic hedging is the market maker change direction. All right. Do you remember? Let me put. So it makes sense now. I think it should make sense now. Now that you see it, remember these guys? Remember when I was saying last class when gamma is 1 day gamma, 2 days gamma, 3 days gamma, what's going to happen is like you're driving this car and then you get a curve, so you got time to stop. Yeah. But if you're driving Fabio's favorite F1 car, the Ferrari, and they go at 300k per hour, what's going to happen? So the market maker needs to put the brake, go to the other direction, right? And we see that in here. So there is friction, okay? And then the price tend to go very quick, right, to the other direction. That's why here we saw this. We saw the market goes to this level and then change direction quickly. But this has to do with this. And now, yes, I think I can copy this.
Yeah, I think yes, Freddy.
Let me copy this, all of this.
They are saying that they hated math in school, but they are loving this.
They hate the what? Oh my goodness.
They hate math when they were in school, but they are loving this lesson.
Oh man. Tell me about it. Here we go. Now, okay, let's delete this. So guys, do you remember we're going up, market maker. Cool. Let's leave like that. Okay. Now. Now, what happens when the price is going get to that max level? Yeah, get to this max level, and then what happens? What happens when what creates the reversal? Remember last time we say because of gamma at this 50%. Oh, forgot to say something. This in the middle is called at the money options, right? So this in the middle is what is called at the money options, which has a delta of 0 minus 0.5. Okay, that's important. Oh, that's important to know, and I'll let you know why. Okay, just right in the middle. Okay, why? Because if you remember, guys, I don't want to. Okay, let's do it on top. Did you remember this gamma profile that we were seeing last time? Well, now we're going to put it together with the delta profile. And what we're going to see is that gamma profile here is something like this. Sorry for my drawing. Right? And imagine this is the gamma profile for calls and puts. Okay. Sorry, this one didn't get right in the middle. So now on this gamma profile, we got the delta, the 0.5 delta. So if you guys remember why the price in, let me put it here in classic. Let me get, this is, why the price get to this level, 7,450 on Friday and reverse, why it went down to 7,400 and reverse. Because remember, look, this is XPX, right? So XPX went to the big node, the major one, 7,400, reverse, and then it went up to 7,450, reverse. You see? Why reverse here, 7,400, and why reverse 7,450? Because first of all, if I am this guy, if I am the options trader who are short the market, because I know it was OPEX, and tell you, these guys are so clever, honestly. These guys are top of the top. So they buy puts because they know we have a pin effect on Friday. It was OPEX. So if I am the guy who buy a put, which means I made money as the price go down, what I gonna do on this level? I gonna take profits, right? So I'm here, the price goes down to my level, I gonna take profits. Why? Remember the class last week. Now on the way up, the gamma, I make, no, I need to do, sorry, I need to decide, otherwise it's not gonna make sense. Sorry, okay. As the price went down, I get to my max positive gamma, the 50 delta. So I'm not going to take any risk. I'm going to take profits. Why? Because these guys are looking this. They are looking the gamma exposure. They know this is what moves the market. They are looking, they are looking this ball structure, and they know how the ball structure works. So what they do, man, the easiest thing they do, they take profits, right? They take profits on 7,400, which was the pin level. Now, what it means for us, it means that as they take profits, remember, market maker was selling futures on the way down. Remember that? As the market goes down, market maker needs to sell futures to hedge, right? Now, when the guy closes the options and says, thank you very much for the put, I make my money, I hedge my portfolio, I don't need the options anymore. What's going to happen with the market maker? The market maker is going to have an imbalance in his futures. He's sure. Now what he's going to do, he's going to buy it, right? It has a relationship with this. It has a relationship with this. Why? Because as the price with the volatility surface. Why? Because as the price goes down, we get to that big level and implied volatility is at maximum. And if you guys remember, when we talk about options, we talk about supply and demand, okay? So if options are very expensive below that level, the market is not going to go there. And for gamma perspective, if we don't have gamma below, the market is not going to continue to get lower. So all this knowledge, and I'm bringing this because when people come to trade gamma, they think they are levels, and it's not levels. It's more than that. So the market have a big pin at 7,400. I'm talking like I am the big guy. I am this big sophisticated option guy, probably working at Goldman Sachs. And the guy said, listen, there is no gamma below. I know there is a pin, so I'm going to buy a put. And when the price gets here, I'm going to close my position, and that's it, because there is no gamma to go lower. He knows that. And he knows that for the term structure, this one here, that's going to be the max of implied volatility. And when the implied volatility gets to the max point, prices are going to collapse. And I'm going to explain why it's going to collapse. Now, why it's going to collapse? Because people are taking profits. And as soon as the market starts to go down, first of all, look what happened with the calls. These calls were in the money. Which means in the money because they are making money. It's like when you take a long position. If you take a long position and the market goes up, you are in the money, okay? Now, with this example, if you bought the call, or forget about the 7,400 on Friday, let's imagine the market are going higher, higher. You are in the money, right? Because your option it has a lot of value. Once you get in here, that's it. You close your position, right? And then market maker has to sell futures. But look what happens. Now the price is going to the left, right? So all the options that were, let me put it here. Let's imagine, no, let's put it here. This is the perfect example. 7,500 is the big level, okay? As the market start to go down, like here, you see, what's gonna happen with all these options? All these options above, they're gonna be out of the money. It's like you are losing money. Why? Because the price didn't reach your level. So all these guys are going to start to liquidate their positions. They're going to put pressure. They're going to put pressure on the price because they are not making any money. Okay. So, and they see this big level. They say, oh, Jesus, market is not going to get here. So we are out of the money. So when these guys are out of the money, what's happened? They liquidate their positions. Now, have a look what happened. As the price moved to the left, now, this delta profile is telling me, okay, now we're going south, we're going to the left. What it means? It means that on the way, on the call side, I don't need to buy. This is, let's put it here. No need to buy as much as on the way up. Ooh. Does that make sense? Remember when we were going up, delta on gamma was telling me you need to buy a lot. Remember? Here, you need to buy a lot because we're going up. So you need to buy futures as the price goes down. Now that we're going south, gamma is telling you, look, gamma is telling the market maker, you don't need, you have no need to buy as much as on the way up. Basically, you don't need to buy a lot. All right. But on the other side, you need to buy more on the way down. You need to buy, you need to sell, sorry, because this is the put. You need to sell a lot on the way down. And let's put this on red. Okay. So now on the put side, why he needs to sell a lot? Because look, we're going to -1, right? Previously on the way up, we were going to 0. Let me put this once because this is key. Now we're going to -1, which means every time the market maker is getting more negative. You see, he's going from, let's say, 0. And as we move to the left, he's getting more negative, which means he needs to sell more. So now is the combination of, all right, on the way up, I need to buy a lot. NQ, I don't need to sell a lot NQ. So here, I need to buy a lot NQ, but I don't need to sell a lot NQ when the prices go higher. Now that we're going to the left, I need to sell a lot on the way down because my puts are going to -1, but I don't need to buy as much on the way up. And that is what creates this friction on the way up, right? And what I mean on the way up, I mean on this volatility surface, not on the price itself. It creates friction on the level and then down. Okay. So your job, what's your job, guys? Your job is wait for that pin, that big node, and have a look order flow, what's happening there. Okay. Because you know most likely it's gonna go to the other way. And as I said before, this is not, I know this is a mountain, but this is an easy way to kind of teach you guys what's going to happen. And if we go back here, right, it's like a ball. Again, ball goes to the price. You get a high implied volatility, and remember, options is all about supply and demand. If I have a high implied volatility, what it means options on the way up are becoming expensive. So if you remember, Fabio, our first kind of meetings, I was explaining that to you in NQ. Hang on, let me go back to
Of course, I
this.
remember. Guys, we had some calls with Freddy because Freddy was explaining me the concept of premium or discount on options and how to filter also the convexity level. So I started to think maybe the level that I see from the order flow, you know, the AAA, no? The delta levels that I see on the order flow are levels that I can predict before from options, guys, 8 times out of 10. When we see this amazing reaction, it's coming. So we not only know the reaction, but we know the reason. Understand the power, guys? Give me a one in chat. Sorry for interrupting, Freddy.
No, please do it because I need to drink some water. It's a lot. Well, listen, this is Guessbot is gonna improve this. I saw it and it's amazing because they are creating something for us, and that's a surprise. They are creating something for us scalpers because Jazz, the creator of Guessbot, he is a futures trader, and basically what they're doing, they're creating something on the volatility surface for scalp so we can see it better. And I can't wait. Listen, this volatility surface, this is in 3D, is basically the same one as this one. Okay, so this is in 2D. So basically, what is this telling me? And this is what I was I remember talking with Fabio is um, options above this level are becoming expensive. Okay. So why? Because they're moving to the right. This is implied volatility. If I compare this implied volatility is 22.9%, and the implied volatility here is 26.9%, which means these options at the top are very expensive compared to these options. Okay. And remember, options is all about liquidity and supply and demand. So if the options on the top are expensive, you cannot think probably this is a topping market. Okay. This is very difficult to infer from here, but this is when you have the order flow to come in and kind of give you a sign. All right. So this basically is telling me when implied volatility is high, there is a chance or there is a high probability that price will come back because everything that we saw in here. And please don't take this as only for longs. It's only for shorts. The same thing that I'm explaining happened here on the way down. Market went down. We go to a big level. Implied volatility is high here. So options below are very expensive. This one. Options above this implied volatility are very expensive. If we move to the right because this is the strike, so what's gonna happen? So what's gonna happen? It's gonna go to the other side. That's why when you trade with gamma, it's mainly mean reverting trades. Okay, and also I'm gonna show you from yesterday, but look, my stop loss was this one. I know, hang on. Now, which one? We went from the major big node to this one, right? So it crossed this one and we went to this one on the top. Obviously, the one on the top is bigger, but the market reversed there on this big one. So this big one is bigger than this one, bigger than this one, but still, look what it did to the price. It reversed the price. And again, this is where you guys have to map or have to match these big levels with order flow because you can have a good opportunity. And you see, it's a mean reverting trade. Now, and it went up to, this is my stop loss, remember, $100 because I didn't look into big trades or anything order flow. And look, went back to the next level and came back down. So mainly it's for mean reverting trades. But I want to show you something that you can also use and have to be careful. And you have to basically use order flow. Okay, because look, let me load today's. One second, it's loaded. Okay, have a look here. And this is the power of order flow. Okay, we have this big node, we have nothing. So if you have nothing, don't trade. Well, I am a gamma trader. I don't trade anything around these levels because I don't have. So the only one which I'm interested is this one. Okay, this 28,789. This is today. So go to the level and cross it. Okay, and cross it. Didn't have any friction. Didn't have anything. Okay. This is the time where I have to look into order flow to see if I see some sort of resistance, if I see some friction. But look what happened then. Tried to go up and it couldn't. You see, it didn't even went up for, what time is this? 10, 11. This is today. So it didn't actually, 10, 11. You know, the friction, the price didn't manage to actually have power. Remember, guys, these levels are where the big guys are positioning, right? So the whole point of trading gamma with these levels is because you know the price is going to go away because of the term structure of the volatility surface that we saw. So look, price didn't manage to cross higher and then reverse. Okay. For me, this is a short continuation. This is a sell. It's easy for me to sell and put my stop loss here. So for me, it wouldn't be easy to sell at 28,780 at 10:13 Eastern time and put my stop loss just above this, which is 28,799, 780, basically the top. All right. And we'll try to go to this next one. But it's just to let you know that you see in the past, we were waiting for get this level and reverse. So look the difference of this price on this level and this one. You see? This one went to the level, bang, quick reaction. You know, you see the very quick reaction. It didn't stay there, it just basically went. Now, today, the one that we saw today, the level, look what it did. It couldn't have that, you know, that traction. It couldn't go there and actually reverse. So this is a short continuation trade. Okay. Does that make sense, guys? Cool. So this is where you have to use order flow, right? This is where you have to see, not go blindly to put a long position, but you need to see order flow, what it's telling you. Okay, this is the way we trade these kind of levels. Now, be careful, and I'm going back to the volatility. In high volatility environment, or no, you know, when it's very high, be careful because the price could move from those prices. It could cross those prices very aggressively. Okay. When they put it here high volatility, but actually when volatility is kind of normal, when volatility is okay, which for me is 20, 21, 22, 23, is when you see these big moves, you know, like go to the level and move, right? So keep an eye. I always have a chart of the bigs in my screens, okay? When you have a low volatility is when the prices start to go around the level, okay? Now, we have seen when it's positive convexity. So it doesn't really matter if it's a call or a put, right? So don't be, because people come here and say, oh, it's a call, so it's going up, or it's a put, it's going down. No. Because of the term structure of the volatility surface, we don't care if it's a call or a put. We only care that it's a big level here, okay? That's it. Someone big position themselves there and is gonna do something, and it's gonna, because it's gonna do something in the volatility surface, all right? So it's gonna kind of affect the volatility surface. Now, this is for buying, okay? This is for buying or selling, but this is something that we are studying, and I want to, hang on, because I'm explaining this to someone else in Spanish. Look, uh, let me put it this. This is something that I'm gonna now do the second part, which is scalping with cues, okay? But before I go into scalping with cues, bear in mind that, let me delete this. Hopefully I won't delete that much. Okay.
Too
Now,
much value, Freddy. Too much value.
awesome. Right. This is, sorry for my drawing. This is the volatility surface. You know, you got the strikes, the time, implied volatility. Okay. We're going to study how to scalp the market with the QQs. And this is another thing that is different, Fabio, because before I was trying to scalp the market with the NDX on gamma profile. So for people, just to make sure, the first setup was using the classic, okay, classic with open interest. So we select open interest, we shut down volume, and this is where we look for the big levels. Now, there is a second way to scalp, or not a second way, but it gives you other entries, which is QQQs. Okay, why QQQs? Because when you go to NDX, because it's so expensive, you're gonna see a lot of selling purple bars, because the purple bars are selling volatility, the cyan bars are buying volatility. What? Right? So we are gonna trade on these cyan bars the same way we were trading on the big open interest, okay, on the NDX. On the Qs, we're gonna trade only the cyan bars. Why? Again, these are positions where the big guys are there, and they're gonna affect the volatility surface. Okay. So if I explain it here, this is something I have prepared for you guys. Okay, this is why don't see, hang on. Why don't see the spot price? Where's the spot price? Spot history. Yeah. Hang on. Oh, hang on. I need to load this again because I loaded this morning. This is from yesterday because I have it prepared since yesterday. Let me bring yesterday. So this is going into the presentation. Now we are gonna trade. Should be here. Okay. Right. So this part, we're gonna trade QQQs on positive convexity trades. Okay. You guys can read this, but basically, what we're gonna do, we're gonna look for positive convexity. Again, is this. When I have positive convexity, where is my, sorry, when we have positive convexity, oh, here. When we have positive convexity, we have these spikes on the volatility surface. And we are looking exactly the same. Positive convexity, a spike in implied volatility, and then the price got reversed, like a ball. It's physics, you know, the ball reverse. So we are going to look for that. And if you allow me to show you an example, this is a trade I took yesterday. Okay. So listen what happened. The market opens, right? It went down. Where is my next positive convexity? I'm tracking the market and I see these are an interesting positive convexity. Went down, right? But remember, we need to look for big ones, you know? We need to look for big levels of convexity. So when the market go to this level, this was an interesting, and also guess what? He show you on the left which one is the maximum positive convexity. Okay, so we have these two levels, and all I have to do again is to look into order flow. All right, I have to look into order flow and look what happened with the major one. Okay, it crossed it. It didn't do anything. So I said, okay, now the next bigger one is this one, 29,150. Now I'm gonna wait. I don't do anything between levels. You see, as a gamma trader, just don't do anything. So my thinking is this could be a reversal because of the volatility circles, right? So I just wait for the price to get there. And look, the guys get there and reverse. You see, went to the level and reverse. If we look that into order flow, you see this one here, this baby here. So that maximum gamma positive convexity is here. And that's what I mean. When you put order flow with gamma, you're going to have amazing trades, Look, do you remember? Hang on. Sorry. Do you remember? You remember the previous, when the price get to this level, it didn't do anything? You see, it didn't do anything. It just crossed it. Why are you sharing this with Fabio? Please, it's too much. Someone is saying, why are you sharing this with Fabio? Please, it's too much value. Well, that's the idea, guys. One of the things, and to do a break, is what I hate the most when I came to the retail world is all these gurus selling courses of thousands, and they teach nothing to people. And people, especially here in Latam, in Colombia, people have a lot of needs, and when they tell, oh, you can be rich doing trading, they only play with their dreams, and it's horrible. But good. Guys, look the level, 29,191. It didn't have any friction at all, That's no a buy. Remember, you have to have friction. You have to see something going on there, and it just cross it. Right? Doesn't mean I'm going short? No. Why? Because I got this big level here. And remember, my bias is long because this is a mean reverting trade. Okay? If the price goes and tested, come back, maybe, because then it led me a place where I can put my stop loss. But look, it didn't do anything. It just went down to my level. So this level is 29,191. Look, 29,191 is above here. Oh, actually here. Do I see anything on the tape? Do you guys see anything here that is telling me the price is going to reverse? No, I don't have anything. I don't even have big trades. I don't have even the tape. My cumulative value is just still red. So there's no buy. You see, it's no buy there because order flow is telling me there's no friction. Market maker is still no buying. There is still no friction here. And to be honest, the key that telling me also not to buy was that I had another level below. Okay. Remember, these levels are magnets. These are like magnets to the price. Why I believe this is a reversal and not this one? Because look, first of all, it's far away. Okay. Secondly, I have a negative gamma in the middle, right? So I think by remember the volatility surface, this might reverse. This is gonna be here. When I get to that level, I want to see this. Look, I want to see friction. I want to see something happen in the level. And that's what I think the key to decode this is order flow. Okay. Because when you have order flow, look, it's as I said to you, it's simple. I don't buy here because I got a big level below. And when the price get to that level, what you have, Fabio, your turn. What do you see in there?
Hello, guys. I see a huge absorption. How many of you will have entered buy here from order flow, guys? Okay. Anyway, Freddy, you are not familiar with the community. We met recently with each other, but I would like to share something with the community. Guys,
please.
Have you ever seen a lifestyle claim or a get-rich-quick scheme from me? Have you ever seen a car? I could drive a Fiat Panda. Never, never done. Go, Freddy, sorry.
That's fine. No, that's fine. I'm being in Colombia. Oh man, it's crazy. I even saw a guy selling a course in options in United States, and because I recently teach this to like 400 options traders in United States that they speak Spanish. And, and the guy who sold the course is this guy who is in a Porsche driving in Florida, in Miami, with a Rolex, telling people, and put $100 and say, oh, with
Yeah,
this $100 you're gonna get
typical,
rich. And I'm
typical
like, oh
guru
my,
cliche.
no. What kind of car do you have? Me? Well, I'm into electric, so I go a BYD. But it's just well, we have two
No,
electric
Freddy,
cars.
Freddy, our friendship is gone. Our friendship is gone. If you are into electric, our friendship is gone. No, just joking.
Well, listen, to be honest, I love cars. And one day, to be totally honest with you, well, listen, I was trading my account, right? It was a small account. And I told you this, Fabio, you can, I was trading my small account because I only need $3,000 in Colombia to live very well. I got my two
Yeah, I know.
kids, they're going to private schools. I live in the best city of Colombia, which is Medellin, and Rio Negro, which is called Llano Grande. And I need only $3,000. So I was trading my small account, making money. But when I met Fabio, and when I saw Fabio in a, Risk channel, Wars of Wisdom, it's called like that.
Yeah,
So
yeah, yeah.
I said to myself, listen, I can also, why no? Why I cannot make $1 million? So I bought my 20 accounts of Apex, and I passed 15, but now I'm worried that they're not gonna pay
and
me.
and you will get all the community banned, Freddy, because
Oh
already
no.
one guy, Vincent, look, Vincent requested a payout of 9,000. He's in the chat at 1,500. He already got blocked.
I
It's
need
you are the reason.
Jesus, no. Jesus Christ. I like what Nicolas say. Plata or guess what? That's nice for everyone who saw the Pablo Escobar series. But anyway, guys, back to the point. Sorry, we have a break because I know this is too much. Look, it is simple as that, right? It's very simple. Wait for the level in QQQs, positive gamma. Wait for the levels, confirm with order flow. Look, we were 15 minutes into the morning. So the whole point, guys, is you don't need to change your methodology. You don't need to change what you learn. Probably this will help you in your trading. Why? I don't know. For any reason, you were short, okay? And you have your 1 to 3 or 1 to 2 take profit, which is around this level below here. You know what? It's not going to get there. Seriously. No, even if you don't use it as an entry initially, if you are sure and your 1 to 3 is below this level, you know what? Take profits here because you guys saw the volatility surface and spot is what the big guys, they're what they're, looking all day long. So that's it. Look, and it goes down. Now, look what happened then. I took this trade yesterday, and guess where I took profits? Here. Because pure gamma. We have the 29,273. Let me show you. Okay. We went back. Hang on. Here. Right. And this is now the cyan bars are called positive gamma. The purple bars are negative gamma. Okay. Everyone with me? So remember, we've been talking about positive gamma the whole morning, which is this. When someone buy options, they take liquidity from the market, imply volatility increase, and that's they take that liquidity from the market, and actually that makes things to go the other way. That's why it reversed. That's why hopefully Fabio is not thinking anymore that stopping a train and at 200K is dangerous. Now with a little bit of like proof of what's
Yeah,
happening in the market, we are not going to be scared of taking these trades, right? This is a train. Look, this train. It's a massive Japanese kind of train going fucking south. Sorry for my language. Apologies for the for everyone. And then that's it. Stop. Why? Because of the bold surface, because the big guys knows what is happening there. They position there, and then the market rallies. That's positive gamma. Okay. Now, where I was here. Why do I take profits here in the negative gamma? And I know you guys like my 3D. This is where you guys like my 3D. Okay. When you have negative gamma, what is happening? This is the bold surface. When you have negative gamma, it's like you make, like the purple. It's like you make a hole in the volatility surface, right? When you sell options, when you sell, in this case, a call, you make a hole in the volatility surface space, okay? Now, if you think the price as a ball, what's going to happen with the price? It's going to be magnet to the hole. It's physics. You know, it's just physics. It's just physics that the price is going to go to the hole, right? And what is that hole? That's the negative gamma here, which is here. So when I took my long, right? When I took my long here, when the price crossed it, I have to think where is going to be my stop. Well, my stop is easy. I put it. It was like, I don't know, $200. Where is going to be my take profit? So when people ask me, Fredy, what's your profit factor? 1 to 2, 1 to 3? I say, no, my profit factor is gamma levels, right? So this is too small to stop the price. This could be friction, right? So the next one is going to be this one, right? So markets start to go higher. And what I notice is this level, the 22,273, start to become really big, okay? Start to become really big. And at this point, it becomes the maximum negative gamma, right? So two things, and I like when I trade with my colleague, because I said, listen, we're going to get to this level. And she's like, how do you know? I say, I know, we're going to get to this level. Now she understands why we get to this level, because the ball is physics. We're going to go to that level. You know, it's physics. That's why these investment banks, hedge funds, that's why they hire mathematicians. They hire physics. You know, all these people with physics. I actually studied with a guy. I did the mindfulness course with a guy who had a PhD in theoretical physics or something like that, and we did the mindfulness training together. And I thought, like, Jesus Christ, you know, these people is out of this world, but they know this, and that's what they do. So what I said when I joked to my friend, I said, listen, the price is gonna go there, and we bet, and the price get there, is because of this physics, nothing else. All right. And that's it. I take the profit there. It's no need for me to do anything else. Just one thing is something that I'm testing, but it's very dangerous to take trades on negative gamma. Okay. Negative gamma will give you some sort of direction. If you are long and you see this big negative gamma, you can think the price is going to go there because of this physics. Okay. But once you get your tape, once you take your profit, that's it. Okay. We were lucky yesterday. And look what happens. The price reverse. And if Fabio remember when we talked the first time, why this place is different, why selling options is different than buying options. Because when you buy options, big guys position there, they are what we call in the gamma space, they are informed traders. Okay. If they put their position there to remember, they enter the market to hedge their portfolio or to hedge their moves. It's like you rent a car and you Fabio Fabio rent his Ferrari, and then he needs to pay an insurance for the car, right, Fabio? You're not gonna rent a Ferrari without insurance.
Of course.
When you return the car, that's it. They not return your insurance. Okay, you see, you pay for the insurance. That's it. Same happened with this positive gamma or positive volatility of buying options. When they put these options here, they pay a premium. They don't care about that. They're hedging the portfolio. They know the volatility surface is going to work magic on them. And that's it. Whatever they pay, they don't care. But when you sell options, your risk is unlimited. People go into the options to sell options because they get money. Like, if I was trading options, you know what I would do? I would sell above this level options. I will go into the queues and sell this level. When I sell options, I get money. It's like I am the insurance company, right? And I'm going to sell car insurance to the market. So when I sell this paper, this car insurance, what happened? I'm going to get the money. Okay. So imagine I am the options guy, or you are the options guy. You sell this 63 million in gamma exposure, you get the money. Okay. And what you want? You want the price to go lower. But what would happen if the prices start to go higher? You know what is your risk? Unlimited. Let me put it here, so you guys will see it. Sorry, guys. Is everything okay? Everyone focus, or this is too much? Sorry.
I think, Freddy, it's really difficult to beat this masterclass. I just need to do.
You can review.
We just need to beat this quality of masterclass. We need to do some live trading together, like some. You identify the level. I pull the trigger, and we snipe.
Don't worry. At the end of the day, at the end of this masterclass, it's gonna be easy. But you need to understand this. Look, if you guys buy this call, right? Let's say you're trading options, you pay $500 for this call, right? And you're expecting the price to be, right? So I like this Excalibur. Thank you, Fabio. I didn't know about it. Love it.
Guys, I'm getting addicted to Excalibur. Also, if I need to make, I don't know, the grocery list, I use Excalibur.
And it's free. I mean, not that we are cheap, but it's amazing that it's free and you can do all of this. Anyway, guys, the guy who buy this option, he pay for this option, right? This is a negative. So I pay $500 with the option. That is why they're called options, that the price move to the right. And once the price cross this level, this strike, I'm going to make money, right? Or I'm going to hedge. We are not cheap. No, we are not cheap. I'm going to get money, right? So if the market finish here, that's it. I'm not caring. I pay $500. This is my stop loss. That's it. That's why institutions trade options. I don't know if you guys know Nassim Taleb. I recommend a book from him, which is called, I forgot the name. I'm gonna give you the books, guy. I promise. It's called like kind of, Unstoppable or something like that. Not the Black Swan, the other one. I'll come back to me, promise. Basically, he said, like, if you trade a product with asymmetric payoff, that's how you make money. And options are products with anti-fragility. Thank you, Danny. Yes, anti-fragility. In anti-fragility, Nassim Taleb say, the way to make wealth, the way to make money is when you trade asymmetric products, right? And the options are asymmetric products because with $500, I can make a lot of money. This is exponential, right? And if you guys remember last week, we said, okay, if I trade NQ and the price moved from here to here, I probably made 1% return, okay? These guys trading the same product with options probably made 300% return. But also on the way down, they can lose it, but that's it. They only pay $500, okay? That's it. How do we do the same as Nicholas Taleb said? Well, and I think this is the base for be profitable and be successful in trading, and is always, 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 you need to respect your stop loss. Yeah. If you have $500 stop loss for the day, that's it. Because why? With what Fabio is teaching you with Gamma, today you're gonna make $6,000, $3,000. Yeah, you not gonna make you need to understand you're gonna lose money. That's the nature of this. Okay. And maybe one day I'm gonna show you a model I did with a flipping of a coin where it shows the importance of this. But if you don't respect this, you're going to lose 1,000, 1,500, 2,000, and then that's going to be something bad. It's going to make, it's not going to be good for your mind. But look, this is how we apply Nassim Taleb teaching. We have the same product in futures, right? The only thing we have to do is respect the stop loss. These guys, they buy the call, they pay the premium in advance. It's basically like they put the stop loss already. They lost the money already. You see, if you trade options, you pay for this, already your bank account is minus $500. Okay? Now, and you can make a lot of money. But anyway, the point was, that's it. When you buy options, your risk is limited. Okay? Now, look what happens when you sell the same call. Now you're going to sell it. It goes like this. I think we saw that last week, but I need to bring it now because it's important for the negative. Okay, so now I am the seller of this call. Now I get the 500 in my account. You see? I'm happy because I sold the call. Now I have the money. But look what happened if the price start to go higher. I expecting the price to go around these levels. Okay. But once the prices start to go higher, guess what? I'm going to start to lose money. Right? I'm going to be negative. I'm going to be losing money. So all these $500 quickly, I'm going to start to lose them. And then my risk is unlimited. I have an unlimited risk. And when I buy the call, which is different than this, I have limited risk. So you guys see the difference between buying a call and selling a call? You see, that's the big difference. Let me put it here. So my risk is limited. Okay. So when I buy options, my risk is limited, $500, fuck it, lost it, tomorrow is another day. But when I sell options, my risk is unlimited. And now, if you go to the big guys, if the price crosses their level, remember when we talked last week, they will have some kind of range. And if the prices start to go higher, they will need to buy futures, right? And then this is going to be dangerous. If you want to short the market here, you're going to have certain probability higher that the price might go higher and you're going to hit a stop loss. You see? Which is different when you take a mean reverting trade on positive. Does it make sense? Yep, cool. So that's why selling options, negative gamma, I use it as a target. And look, yesterday was a beautiful day. Look what happened. You see, let me put it. Oh no, we saw it in. Guys, price went there, came back. Guess what? I was ready to buy again. Okay? It's like a resistance. It's like, the technical analysis, how they call this? Double bottom. They say, oh, the double bottom, blah, blah, blah. But they are not looking at this. Look the friction of the market there. Shall we see it in our platform? Look. Ta-da! Again, big trades. That's it. Doesn't make easier than this. Right? And then big trades, go long again to what level? This level. And that's it. I passed another 5 accounts yesterday with these 2 trades. Okay. That's easy. I mean, easy in the sense that all you have to do is wait for the level. Okay. And That's it. Now, what happened on the third time? And this is where you have to bring your experience of trading. If it comes down to the third time, you see, okay, wait a second, something is wrong with this. Okay, if it goes down to the third time, careful with this, can go lower. Okay, and I think that's what happened. I can't remember because I closed my, oh yeah, it went lower. Yep. Jesus Christ, 2 hours non-stop. All right, guys. So I
Guys,
think
do you enjoy or it's too difficult? They enjoy, Freddy.
amazing.
They enjoy. Maybe we can do some Q&A to clarify their idea, Freddy. You have other 20, 30 minutes.
Yeah, definitely. Well, I'm gonna finish this off with this, guys. You need, every futures trader should know this. OPEX is every third Friday of the month. Why? Because you know now how the options moves the market. Okay, so you should know OPEX. OPEX is the expiration of those monthly contracts. They expire the third Friday of the month. Okay. Now, triple witching. Triple witching is the third Friday of March, June, September, and December. Why triple witching is important? I don't trade triple witchings. You know, I go with my wife, have a coffee, and have fun. I never trade triple witchings. Why? Because this day, options, equity options expire, index options expire, and options on futures expire. So we have like 3 of the major products in the market expiring that day. So what's happening? Lots of institutions, they close their position or they roll over their position, which means if I have a call today, I need to close my call and I need to open a new call for the next month. That's creating a lot of uncertainty on the market. And because we trade zero DT options, I'm not having zero DT options. So my hedge is gone. You know, my hedge is gone. So I don't trade it. Expiration is very important because it's monthly and it's exactly 30 days before the third Friday of this OPEX. I put the calendar here. You know what? Let me put it. Let me put the calendar also in the chat, so you guys can have it. It's free. It's a free calendar. And please, 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 you need to have this calendar in mind, right? Expiration is important because it's on Wednesdays, right? And you know what time the expire is? I mean, sorry, expiration is the expiry of options on the volatility index. As you can see, the volatility, or as I don't know if you guys know, the volatility index, you can trade it with options, and it has a negative relationship with indices. So as the Nasdaq goes up, the VIX goes down, and you can trade that with options. So that day, monthly, these contracts of options expire. And you know what's the interesting part? They expire at 9:30 in the morning, just when the market opens. I've been tracking this, and this is the times when I see a big move in the market. So what I do in expirations, I don't take trades in the first 15, 30 minutes. I'm with you, Fabio, on that. But I only do it on expiration because all those options are expiring, and that creates a lot of volatility in the market. And there is also the JP Morgan equity fund caller. What it is, they have a hedge fund which is massive long SPS. So every quarter, March, June, September, and December, the last day of the month, they execute or they roll over this collar. It's a huge one. It's huge. So that can create some sort of, friction in the market. It will be when the market goes up and up and up and up and up, and it doesn't reverse. So because I'm with Gamma, I take reverse trades. Sometimes I say, okay, instead of taking reverse trades, am I gonna continue with the trend using Gamma? Okay. So guys, this is the main volatility events that every trader should know. Okay, it's gonna save you money, I promise. Okay. So yeah, I think I'm done. Next, I don't know. I'm not sure if next week or whatever I'm gonna talk with Fabio when we can do it. Uh, I'm gonna promise to. We're gonna go through order flow, guess order flow, which is amazing, and we're gonna try to get ready the mindfulness for traders.
Amazing. So they were asking this, Freddy. You will share with them also the mindful that you took for JP Morgan and this stuff because
Yeah,
they
yeah, yeah,
were
yeah.
asking. You can
I need to
help.
put
I
it in
think
English. I'm doing it. So
amazing, guys. Amazing. So, what's the final feedback, guys? And are you ready, Freddy? We will have another session on Thursday. Maybe we can do some analysis together. We can do 3 hours. So we can finish the presentation and then do some trading together if you are free. Otherwise, I will do with them with the level
yeah,
of the options that we saw. And if I can steal from you 20 minutes to do a Q&A with the guys, because I know that they are super excited and they will have a lot of stuff to ask. So if we can go over it, guys,
sure.
ask anything related to what we saw now, and let's understand how we can implement this in the market. Any question you have? The guys were asking Freddy, why NDX and not SPX levels?
And the X.
Yeah, why NDX?
Oh,
He
yeah.
explained this to me. It's a smart question.
Yeah, no, good. Listen, just because of this, um, how to put it? One NDX contract in options, you have all these strikes. So you have one standard deviation. Sorry, guys, maths again. You go within the first standard deviation, a price of one contract NDX is between $10,000 or $12,000. I can't remember. It's something like that. I haven't traded this in a while because I'm making more money in futures. So and it was too much. It was too much looking futures and options. I was crazy. But when you go to the Qs, remember the Nasdaq, okay? For the Nasdaq, we track the Qs or NDX. Are the this is the ETF, okay, and this is the index. So the QQQs in the same one standard deviation, I don't know, between $60, I don't know, $70, okay. So remember, what are we looking, guys? We're looking to big guys. I'm looking for the Goldman Sachs guy here. I'm looking for James Simons on Renaissance Technology to come and put $130 million. So that guy is gonna go here to the NDX. Why? Because if he's got 130 million, he's not gonna go and buy QQQs. He will have to buy thousands of contracts. Instead, he will go to NDS where he can buy less contracts. That's why I'm looking for the big guys, because when the big guys put the big money, that's where the market reacts. We've seen it. And if you guys, I think I left last time a code and a link so you guys can get Guessbot with 65% discount for the first month. So you can go on and test it yourself. Go what we learned today. You go 90 days in the past and go and have a look at it yourself, and you see how these big levels works. You drop the code, Fabio. If you
Freddy, they ask also why not SPY?
I'll second. Hang on. I put it in the guess code. Spy. Why no spy? Right. I look SPX, right? Remember, SPX is for buying on the low, selling on the high, because this is the biggest index. Institutions, and this is from research, when they want to hedge, again, big institutions, pension funds, CTAs, they came into the XPX to hedge their portfolio. Again, exactly the same reason. Can't remember, I haven't traded this for a while, but one contract in XPX, I'm gonna put a number, I don't know, it could be $5,000. But on a SPY, one contract could be $50. So people with a lot of money, they come to XPX. And the whole point is we're looking for these big guys, what we call informed traders, to put the positions in the market. And bear in mind, these guys, they have amazing teams, mathematicians, all these crazy people, and they say, you know what, put a level there. That's it. We as a retails, we don't have access to these resources. Like having a quantitative desk, a market analysis, an economist, IT. We can't, but we don't need to, because we know where these guys are positioned, and that's like that's something that I miss, to be honest, from the
This
institutional
is the
world.
approach. This is the same approach, Freddy, that I use for the filter of contract. Is like why I should be smarter than someone executing 200 contracts on the NQ. He knows something, and the same it's for
Yes.
options. It's beautiful.
Yes, exactly. That's the whole reason. I don't know, Fabio. Any more questions? You manage the questions and I reply.
Yeah. I'm watching how to find the pin moments besides level of positive gamma. Maybe you can explain the research part, Freddy. They want to understand how you can predict pin days.
How can I predict what? Sorry.
Pin days, like Friday.
Oh, guys, again, this. You need to know this. You need to do the ball events. This is what you need to do. And pin days are OPEX, right? The only one I trade is OPEX. Okay, that's it. I don't trade the triple witching. And remember, as I say before, let me find it. Pin days is very easy, or the pin level, let's put it that way, is very easy to see because let me put it here. What is the other one? When you use Getboard Research, which I think we need to see it next time because I don't think we have much time. I get this from Getboard Research. So I at that time I knew XPX was going to open to 7,400 at 15 or something like that. So what's the natural level where the price might go to the big level? Remember, these levels are magnets, okay? And on OPEX, all of these contracts are going to expire on OPEX day at 4 p.m. So there is this magnet for the price and then reversion, right? So when you have these pin days, you just have to wait for the price to go to the level, okay? But this is OPEX because you need to know this and have a look at the calendar and keep that in mind. And we're going to see it next time, I promise. So we're going to see Guestbot Research. When you go to Guestbot, to the website, you got this Guestbot Research, and this is where you get that information before the market opens, and also every 15 minutes when the market is there.
Amazing, Freddy. And they ask if they are the same, the levels on the QQQ, on the NDX, sorry, and the SPX. No, they are different, guys. But I remember that for the SPX, we checked the zero gamma level. I remember it works amazingly.
Yes. So listen, what I do, basically, I have one screen with this, classic NDX. I'm looking for these big nodes, not the middle ones. I'm looking for the big ones. And then I'm to be honest, I'm kind of learning a lot to see order flow, all of this rejection, absorption. Sometimes I open the candle to see what's happening inside because I need to see some sort of friction, okay? So I have this one. I have, forgot to mention, thank you. These levels are very important. The first, kind of rule of thumb, the first 2 hours, okay? Because as the time progresses, there's going to be lots of people trading these levels, trading different levels, and this information start to be less, how can I say, less spot on, not less important, but less accurate. Why? Because imagine I'm going to this level, but it doesn't really matter because we don't know if it's calls or puts, they are opening or closing. But from my chat with the guys from Guestbot, they prefer to do this in the morning. And also I trade only the first 2 hours. And I told you, in the afternoon, there is a second order derivative charm, which is telling the market maker he needs to hedge in order to time, not to the spot price. in relation to the time. So until this guys doesn't create something where I can see charm, I'm very, very not scared, but I'm very worried to trade in the afternoon sometimes. If I see a big level and I have confirmation for order flow, I might do it, but I only do it the first 2 hours. So anyway, I got this one, and for have these mean reverting trades very early in the day, 15 minutes, 30 minutes when the market opens, and then I have state QQs gamma to look for positive convexity mean reverting trades or continuation if it's the case, and have a look the negative ones as targets and see, see what's happening there. See that if I'm long, as I said before, and I'm long and the price, this is interesting because this is a good analysis that we can do with order flow. I'm taking the long, most likely I'm going to have a volume profile distribution here, okay? And if the price enter my value area low, most likely it's going to go higher, or it's going to go
Exactly, Freddy. I was
but look,
thinking about it.
yeah, and look the value of negative gamma, and I'm going back to my draw. I love my this is the best draw I've done on on volatility surface. I love it. I think I'm gonna print it. I'm gonna put it in my room like my daughter does. So look what happened with negative gamma. This is magnet for the price, but because of the volatility surface nature. So imagine you take this long, right? And you are getting out somewhere here because you go to the volume profile and you go your POC here, you see? And you take profits because the POC is there. But when you see, and when you learn today with the volatility surface relationship to spot, you could say, you know what? No, I'm not going to take profits there because look, this negative gamma is creating this vacuum and the price might go there. So I'm going to take the chance, and look, that's what happened. So I'm not saying goodbye to all these, the concepts that we know, but it gives you a third dimension view. Don't take the profit on POC, protect your profit on the previous low, but you will know now that there is a high probability the price might go to that negative gamma level. I don't know. It's a lot to work on, Fabio. To be honest, this is
no. It's I don't know how you managed to explain this in only 2 sessions. You did an amazing job. But we will go over and over with this on the guys. I think they will love to have a session us together trading live market, live account. Yeah, and Freddy will call the shot, and I will use order flow to time it. And guys, I don't know. Give me a feedback about this lesson with Freddy. And let me know if you appreciate it. He took the time. It's one of the most experienced trader I know from an institutional background. Thank you, Freddy, from the heart. We are creating a community that doesn't exist in the retail space, okay? We are creating something that doesn't exist, and I'm so proud of this. Thank you for everyone that was here. Now, I will take 5 minutes of break because I'm thirsty. I cannot breathe anymore. And then I need to show you 10 minutes a surprise of XAX, okay? That will be uploaded next Monday. So thank you, Freddy.
That's for me as well? Huh? That's for me as well?
No, you can go. Don't worry.
No, but I want to see the surprise. Why are you not showing to me?
I interrupt 1 second the live. I go to take something to drink, guys, and I come back, okay? And I show you. I will send you also. Don't worry.
See you.
Thank you, guys.